If you buy B-rated bonds and they survive, then all the surprises will be on the upside. If they survive are still the three key words. Here, Moody's was saying that a B-rated bond is a bad investment. Well, what about at 75 cents on the dollar? What about at 50? What about at 25? Is there no price? Most people believe that the things that everybody think are risky are risky. I think the things that everybody thinks are risky are safe because their aversion to it forces down the price to the point where it is safe. What is the role of the rating agency? The role of the rating agencies is to be wrong because it gives us something to game against. After the Nifty 50 thing didn't work out so well, is when I transferred to money management at Citibank from research, and I was put in the bond department. They wanted to keep me away from stocks. And I got a call in August of '78, and they said there's some guy named Milken or something out in California, and he deals with high-yield bonds. Can you figure out what that is? And the world didn't know. And so, I met with Mike, and he explained to me that if you buy B-rated bonds and they survive, then all the surprises will be on the upside. If they survive are still the three key words. And if you buy high-yield bonds today at their paltry yield of 5% and they survive, you'll make 5%. And
well, you could get some upside, right? They could be acquired by a double A,
they could. Some good things could happen. And in fact, most people are terrified of rising interest rates because it depresses the price of a bond temporarily. But if the credit is good, it still goes back to par when you get paid off. And in the meantime, the coupons are reinvested at a higher rate than you anticipated. So it's really not bad news. So you could do a little better than 5 if they survive. And the point is that nobody ever went broke making 5%. So you could wish you had more, but if it turns out, if high-yield bonds today turn out to have been a mistake, and I know there's been discussion at this conference of whether it is a mistake, it's not going to be a big mistake. It's not going to be a fatal mistake. And what you have to be aware of in the investment business is what carries you out. And it's not going to be credit-worthy bonds that you bought at a 5% yield.
In many ways, if you buy a long-term asset, it's really not the coupon on the bond, it's the reinvestment rate that's the key. And when interest rates spiked in 1974, insurance companies like Equitable Life Insurance Company and others wrote annuities where they were guaranteeing rates for a long period of time so you could compound your money. As interest rates dropped precipitously by 1977, they could no longer reinvest their money at the rates they were guaranteed, and they had a lot of economic challenges and eventually were acquired and merged. And I'd like you to go into that reinvestment rate a little bit, Howard, if you could.
Well, it's really, you have to be a bondo. You have to be a bond person to understand this.
Now, have you patented that name?
Most of them have died off.
Have you trademarked that name, bondo?
Well, I think there's another guy who has.
Okay.
But everybody knows that when you buy bonds, you get the promised return through the coupon. And everybody knows that if you buy them at a price different from par, and they pay, they converge to par. And that those are two dependable sources of return. But most people who aren't bond specialists don't understand the importance of the interest on interest. And if you look at a long-term bond, like a 30-year bond, most of the return at the end of the day will not come from the interest or from the appreciation to par, but from the interest on the interest. So clearly, then it's a key moving part in the equation. And the question is, what interest rate do you reinvest the interest at? And when you buy a bond at a stated yield to maturity, the calculation assumes that the reinvestment will be at the quoted yield to maturity, but it doesn't have to be. And the truth is that whereas people are petrified to see bond rates rise, as I said before, because it depresses the price in the interim, it does facilitate reinvestment of the coupon at higher than expected rates of return. So it is actually a boon.
And the probability that you're going to be able to reinvest the money at that exact rate is extremely low, very close to zero.
So it's a somewhat illusory calculation. Most people equate risk with low-quality assets and safety with high-quality assets. And they still do. I mentioned the Nifty 50. High quality, people thought, there's an old saying, you can't get hurt buying IBM. And we documented you lost 80 to 90% of your money. On the other hand, what about low quality? Is that a source of risk? When I got started in high yield bonds back in '78, I looked up in Moody's, what does it mean to be single B? And Moody's defined a single B bond as follows, quote, fails to possess the characteristics of a desirable investment. In other words, low quality asset can't be a good investment. Well, is there no price at which a low quality asset becomes a good investment? If we went out after this session to the parking lot and I said to you, I'd like to sell you my car, would you like to buy it? And let's say you like my car and you have money and you need a car. Hopefully there's one question you would ask me before saying yes, and that's what's the price? And here Moody's was saying that a B-rated bond is a bad investment. Well, what about at 75 cents on the dollar? What about at 50? What about at 25? Is there no price? And so this is the kind of herd error that you can take advantage of. So risk is not quality. And, most people believe that as something is rising in price, that means that people think better of it, it's less risky. Well, I think that when something rises in price, it becomes more risky. Most people believe that the things that everybody think are risky are risky. I think the things that everybody thinks are risky are safe because their aversion to it forces down the price to the point where it is safe and potentially lucrative. What is the riskiest thing in the world is the belief that there's no risk. Risk is perverse. That's the important thing that's what the chapter in the book talks about, it's the perversity of risk. And it's the belief, like in '07, the belief that there was no risk is what made the world risky. And in late '08, after Lehman Brothers melted down, the belief that there was no potential future is what created a great potential future.
The rating agencies keep the same rating on a security, whether it's 100 or 25. It might be a triple A at 25. It might be a single A at 50.
And by the way, the rating agent, you and I should have a word for the rating agencies. I was speaking at Wharton one time, and somebody said to me, "What is the role of the rating agencies in this process?" I said, well, the role of the rating agencies is to be wrong, because it gives us something to game against. I don't know how many people in this room know how many corporations are rated AAA today, but the answer is 4. How many mortgage obligations were rated AAA in the mortgage wave? Mike tells me 16,000. I believe him. So is it possible that after 100 years of economic history, our economy only created 4 AAA rated companies, but in a few years, Wall Street was able to create 16,000 AAA rated mortgage obligations? And it was probably the greatest opportunity to make money in a lifetime, in a short period.